Hi, this is Stuart Weems and welcome to the Investopoly podcast. My goal is to give you simple, easy to understand strategies, insights and tips to help you master the game of building wealth. And in this episode, I'd like to talk about property versus shares, but really approach the debate differently. See, it's my thesis that property is an okay investment, but not as good as shares. However, when you factor in the gearing, so the ability to borrow to invest in property, the ability to invest in property without contributing any of your own cash, at least up front, property becomes a wonderful investment, much better than shares. And so that was my thesis. And what I wanted to do is sort of pull apart the numbers to try and demonstrate that to listeners. But before we do that, let's talk about some pros and cons. So really, let's talk about the main advantages of shares and or property. So let's talk about shares first. Of course, with shares, it's a lot more hands-off. You can outsource the management of a share portfolio to a financial advisor like myself, or if it's a relatively small amount that you've invested, you could just invest in, some diversified index funds. And you don't need to do anything. In fact, iShares, its ASX 200 index fund, iShares actually reduced the cost for that fund to 0.05 of a percent or 5 basis points, whatever it is, it's super, super cheap. If you invest $100,000 in that fund, you're paying $50 a year in investment management fees. As I said, it's really cheap and a really easy way to do it. Whereas with property, sometimes it can take time. You might have to spend time managing the managing agent or dealing with tenant issues or arranging property maintenance and repairs. So from a hands-off perspective, shares can be or is often a less time-consuming asset class to invest in. The other advantage of shares is it has a more stable level of income. It depends on how you invest and how your portfolio is structured, but it can do. So, for example, the ASX 200, top 200 stock index in Australia, has yielded circa 4.5% pretty consistently over a long period of time. So again, if I put some money in there and, I want a stable level of income, shares are going to do that. Whereas again, with property, you could have unforeseen expenses that come out of nowhere that impact your income. And also, finally, the major advantage with shares is liquidity. So low entry and exit costs, which is good. No stamp duty, real estate agent fees, buying and selling costs, etc. are negligible. But it also means that you can invest and divest in small increments, which gives you a lot of flexibility as you get older, or particularly if you want to potentially reduce your working hours before you get to age 60, which typically most people can access super. Having a portfolio of shares gives you that flexibility. Okay, so let's talk about the advantages of property then. And firstly, and arguably most importantly, as I'm going to demonstrate today, is that most investors feel comfortable borrowing to invest in property. And that means that you can, or it forces you, firstly, to invest a large amount upfront in one transaction, which is good from a compounding capital growth perspective. And it means so long as you can comfortably afford to service the borrowings, it means that you don't need to contribute any cash up front. So the ability, firstly, and then the comfortability with borrowing to invest in property is its most substantial advantage in my view. Secondly, the asset's tangibility can make investors feel more comfortable. So again, this is really, I would say this is more of an emotional consideration, and really we shouldn't let our emotions guide our investment decisions. I would much rather try and counsel someone to understand different options and why they might not be as risky as they first seem. But certainly it's true that some people feel a lot more comfortable with property because you can walk through it, you can see it, it's very tangible, it's a very tangible asset. You don't need ongoing financial advice if you're a property investor. Typically, you might obviously get advice from a buyer's agent when you first purchase the asset, but from an ongoing advice fee perspective, you don't need advice in regards to property. However, of course, if you have $1 million invested in the share market, I would argue most people should have that portfolio professionally managed by a financial advisor. And lastly, investment grade property delivers most of its return in capital growth rather than income, whereas particularly with Australian shares, it's about 50-50 even amount of income and capital gains. Well, it's just going to depend on your age and stage of life and your other assets, which is more appropriate. But certainly from a taxation perspective, having more capital growth and you can compound that growth without paying tax until you sell the asset, from a taxation perspective, that is far more powerful as a way to actually build net wealth. And so if that's your goal, property certainly ticks that box. Now, we can debate which is better, property or shares, but I really think it's a meaningless debate. I think the answer is that they're both really good asset classes, and that most investors would be well served by investing in both of them, maybe at different times or stages of life. But by the time we get to retirement, however, hopefully we've got a broad spread of different asset classes. And to argue one is better than the other, I think it's use the analogy, a golfing analogy, it's a little bit like saying, which is the best golf club. The answer is that you need a variety of golf clubs for different shots in order to play golf well. So as I said at the beginning, I think it's really the gearing that is associated with property that drives most of its returns, not the property asset itself, which is not to say property is a terrible investment, but really just to recognise that it's the gearing that works or that drives property returns, not property in itself. And so instead of it being a shares versus property decision, I think it's more correctly a gearing versus no gearing decision. So if you're in the financial position where borrowing to invest is safe, you're comfortable with it, it's appropriate for your circumstances, then it's really go and borrow and invest in property. However, if borrowing now, increasing your level of borrowings isn't appropriate, then it's really invest in shares. And so that's why I think it's a gearing versus no gearing decisions rather than a property versus shares debate. Now, for those that have listened to this podcast for a while, you know that I'm just not here to share my opinions, that it's all about the evidence. And I think adopting an evidence-based approach really reduces your risk. And that most things can be explained simply using basic logic or maths. And so this is what I wanted to do, is use some basic maths to model different investment options to sort of pull apart the returns. So what I did is I financially modeled borrowing to invest in a property for $1 million, holding that property for 25 years, and then selling the property to realise the cash sale proceeds after repaying the original loan that I used to buy it or to fund it, and also capital gains tax and any other selling costs. And I've got all the assumptions listed as you would expect in the show notes and in the blog on the website. Now, the benefit of doing this, that is borrowing to invest, means you don't have to contribute any cash up front, but you do have to contribute cash towards the holding costs. So, of course, that the interest is going to be more than the net rental income after expenses, and you, the investor, has to meet those costs, and really that's your cash capital contribution towards the investment asset. Okay, so what I did is I used the internal rate of return as a calculator that kind of measures, when you have to make those cash contributions over the 25 years of holding that property, and then you get a big reward in terms of, the cash sale proceeds when you sell. The internal rate of return is 13.96% under that situation, 14% internal rate of return if you're investing in property. It's a really good return, right? There's no doubt about that. However, if you take the borrowings out of the equation, so let's say you, instead of borrowing $1 million to go and buy $1 million property, you put in $1 million of your own money, the internal rate of return drops from, let's say, 14% down to 7.4%. So almost half the return if you take the gearing out. So gearing adds, 45% of the total return. In fact, I've got a chart which sort of splits up how much of that total return is delivered by gearing, rental income, and capital growth, how much is subtracted because of tax, mainly capital gains tax. Of course, you get some negative gearing tax benefits, but the capital gains tax is the big negative net from a net tax perspective. So anyway, if we compare that to a shares option, still ungeared. So if we, instead of taking our $1 million of cash and going and buying investment property and generating an internal rate of return of 7.4%, what happens if we put that $1 million into the share market, particularly the Australian share market? The internal rate of return is 10.3%, so almost 3% higher than an ungeared property investment. So that's why I say if you take the gearing out, shares actually generate better returns, net of all taxes, than what property does. Now, just as a side note, of course, most investors aren't going to feel comfortable dumping $1 million into the share market tomorrow, because the reality is share markets have twice the volatility that property markets do, and I myself wouldn't advise that typically either. So then I looked at once if you invested that $1 million over the next 25 years, so on a monthly basis, invested $40,000 a year for the next 25 years. The internal rate of return is just under 8%, still better than property, even though I'm investing those monies over 25 years. So no matter how you cut it, shares, taking out gearing as an ungeared investment, shares are better than property. And as I said, it's got the advantages of having the liquidity, which means you can invest and divest in increments, which is, as I said, really valuable. It's the gearing that drives all the returns with property, and we wouldn't be comfortable gearing to the same level in the same way as we do with property as we would with shares. Of course, that makes sense, right? So it's not a shares versus property debate. It's a really gearing versus no gearing decision. So what are some of the considerations you need to factor in when deciding whether to gear or to borrow or not borrow? Let me list a few. Of course, it's not an exhaustive list. It's going to depend on your own individual circumstances, but here's some things. So firstly, of course, will the banks lend you any more money? Do you qualify for a loan? That's actually a big consideration today, given the pressure on borrowing capacities. I'll write about that in a few weeks' time. Whether your borrowing capacity is in fact enough to be able to buy a good quality asset. So whilst you might be able to borrow a certain amount, maybe it's just not worth investing in property because it's not a substantial enough amount, in fact, that you'll have to make some compromises on the quality of the investment property that you might otherwise buy. Of course, you need to think about your net asset base. If you have a really low asset base, then really gearing is more important. If you already have a well-established asset base, then arguably you don't really need to add the gearing, the additional risk of gearing. How close you are to retirement and or your desire to reduce working hours in the future. Adding more liabilities just increases your monthly commitments and perhaps gives you less flexibility rather than more flexibility in the future. The mixture of existing assets that you have, investment assets that you have. If you already have a whole bunch of property, well, maybe adding shares to complement the portfolio now is a better option. If you have no property, well, it might be a no-brainer to add some. And of course, your appetite for risk. How comfortable are you with borrowing to invest in that approach? In fact, I recorded a video about 5 years ago that sort of walks you through the typical life cycle of an investor. So certainly check that out. I put the link in the show notes, of course, and it sort of takes you through, and gearing is one of those major considerations. Investors that first start out are typically, gearing suits their situation a lot more than, say, someone that's approaching retirement, of course. So just to sum up, I think both asset classes are fantastic. I invest in both, as you would imagine, and they serve me very well, and they serve other clients really well. So I'm not going to be drawn into a debate which is better. It's really just a question of which should I invest in now and what proportions. That's really what most people are kind of considering. I would argue that most people would be well served by investing in both. But it's quite possible that, particularly people that are younger, start with property first because that adds the gearing, builds your net worth, and then add shares later. With people that have already accumulated a bit of property, start thinking about adding shares and the benefits of doing that and the flexibility that it provides in the future. Okay, that's it for me for this week. Until next week, bye for now.